think we are live. Shall we get started? Good morning, everybody. Hit pause on the music. We're good on Facebook, LinkedIn, YouTube, X, and Instagram. All right, welcome. Welcome, everybody. Let's get going here to Mornings with Scott, the best damn business show for medium and small businesses on the planet. Bad economic news this morning from the US. The good news is that inflation numbers have pretty much dropped. They were below 3% this morning. That was good. But the reason they're down, of course, is lowered economic activity. Manufacturing's down, consumer confidence is down, markets are uncertain as to what the hell's going on. There's now a risk of deflation. Labor markets, they're expecting significant unemployment for that to start spiking. So that's what's going on in the US. And just remember, we've talked about this over and over again since I've started these morning live streams, and you can, in your business, hunker down and get through this with cost controls and with getting your financing. Make sure you have access to capital. That's what I'm trying to say on that. So bad news more this morning. Maybe I'll cover more of that tomorrow. Well, I told you I launched a course. You can see scrolling across the bottom of the screen here some of the content of the modules of the course. If you're on audio, you won't see that, of course, but I've talked to you about it before. I worked on this course for maybe a year and a half. It's been percolating in my mind, and it's been framed out, and I'm really excited about it. And for your medium and small business, it's going to help you raise business capital. You can get financing, and I've done 25 billion in transaction value. So I have some views on how to get this done. A lot of that for struggling businesses. So you can raise capital and you can earn more profit. And you need to do the profit part to get the business capital part. Obviously, well, I've put together this course. It's in 8 modules. I've told you, in other words, 8 videos, and there'll be supporting materials that go along with that, workbooks or however that gets framed out. We're not done that part yet. And, each video is 45 minutes to an hour. So you're talking, 6.5 to 8 hours of content. And first one's being released in September, and then every month after that. That's the general idea. You can buy them as a bundle. You can buy them in individual courses, whatever you feel is the most value to you. And I'm promoting now pre-sales at significant discounts. 50% discount, and then I provided a code for an extra 25% discount on top of that. And some of the stuff we're covering is how and when to change, because if you want to improve if you want better results, you need to change your actions, right? And so I provide ways to do that and ideas of what to change to. Cash flow modeling, improving cash flow, profitability modeling, what you should do first, second, and third to earn more profit in your business, how to create or manufacture momentum, and the importance of momentum in attracting resources, both human and capital, how to finance a business, how to create a team. You can't do everything yourself. You need to empower your employees, and you need to do that in a value-centric model. We talk about that in a module: marketing strategy, persuasion, sales. So all of this stuff, it is a most comprehensive business course you can possibly imagine. And so I've been talking about that all this week so far. I think we started on the weekend. And it's been a significant commitment by me, a little bit like giving birth, I like to say. To which someone replied on YouTube, the course is too long and too expensive. You need to look into a course that isn't dumb. There you go. We've had lots of great feedback. But if you find this course is expensive and dumb, expensive and long, maybe it is dumb for you. You need to find a better course that fits your needs. But if you're really looking to try to understand how to raise money for your business. 98% of businesses never, ever create intergenerational wealth. You don't become profitable and you can't sell your business. So we're trying to change those stats. That's what this course is for. And if you don't want to do that, if you're not looking to create a business that sustains your lifestyle and creates wealth for yourself, then don't buy the course. The course is cheap. The course is cheap in the grand scheme of things. Well, I know most of you believe that Canada, where I'm sitting right now, for the most part, Canada is unable to produce much of anything these days. Our manufacturing sector is hammered. As of August 24, the S&P Global Canada Manufacturing Purchasing Managers Index is recorded at 47.8. 50% means like you're in trouble. We're below that. We're at the lowest we've been in a long time, long time, 47.8. Canada's taxes are too high, way too high. So you're unable, if you earn a little bit of profit, to reinvest in your business at the rate that you ought to be in for automation, AI, machine learning, all the things that are important in manufacturing. Regulations are too burdensome. Business capital is dried up a lot. It's really difficult. We're talking about financing today on the show, but it's really difficult to finance startups and small businesses and medium-sized businesses. The labor market in Canada is difficult for all sorts of reasons. And so in Canada, we're not producing much of anything these days. Obviously, there's large manufacturing exceptions to that. But the good news is the RCMP reports yesterday. That's the Royal Canadian Mounted Police. Do you remember Natasha and Bullwinkle and the RCMP guy with the horse? Canada's organized crime groups are shifting their efforts to producing domestic fentanyl as opposed to importing it from overseas. So it turns out we can produce something in Canada, as fentanyl imports from abroad began to slow down in 2018 and 2019. That was when there was a hard crackdown on the border by the Trump administration. Gangs began producing it domestically to keep up with the demand. And so we have that going for us in Canada. Apparently, taxes, regulations, lack of capital, labor shortages are not major depressors of the fentanyl manufacturing industry. There's a big problem in Canada, a terrifying problem. According to StatsCan, over 8,000 Canadians died from opioid overdoses last year, averaging 22 per day. So for you U.S. viewers, which is a majority on this podcast, rule of thumb, multiplied by 10, right? Your country's, America's roughly 10 times the population, not exactly, but roughly 10 times the population of Canada. So for everything we do here, we just multiply by 10. So if we have 8,000 dying a year from fentanyl, that would be similar to 80,000 in the U.S. context. The real number in the U.S. is over 100,000. So the U.S. has a worse problem than Canada, but somewhat comparable. Opioids also accounted for, well, a lot of problems. 42,000 emergency medical services in 2022. You get the point. This is a big problem. So financing. Let's talk about financing. And one of the keys to raising capital for a medium and small business. I'm almost over my cold, so I hope I sound much better today, but I'm not 100%. One of the keys to raising capital is to understand the suite of products, capital products, business capital products that are available to you in the marketplace. When you talk to a bank, are they trying to help you or are they trying to sell you a suite of services? Well, probably both. Sorry, suite of products. Well, probably both, but they do have defined products that they have manufactured, created to help businesses grow or to finance certain assets of a business, right? If you talk to a venture capital firm, there's something that they do that is very specific. They're not meeting you and treating you as a client, as a service, as how can we sort of amend what we're doing to fit into what you're doing. That's not what they're doing. They have a black box. They have a product, and you either fit in that black box or you don't fit in that black box, right? And that's the way that financial markets generally work. And so if you don't understand that, and if you don't know what suite of products are available to you, then what you're going to end up doing is you're going to, and I see this all the time, you're going to end up pitching the wrong business, the wrong opportunity to the wrong party. And it's going to become a frustrating process. And the problem with doing that is not that you've just wasted some time, right? The problem with doing that is that it just becomes overly frustrating and you think that your business is not worth financing or that you're doing something uh, in your business that is wrong. But that may not be the case. What may be the case is you don't understand what it is that your counterparty, that the financing institution is looking for. And so you're not getting the deal done. So what you need to do is start to understand the products. And I'm going to tell you right now, if you're not in the industry, in the finance industry day to day, this is a lot. It's overwhelming. It's a massive industry, the financial industry, trying to support businesses. And because of that, there are so many different products with bells and whistles. It's infinite. We couldn't possibly go through them all today. But I did ask the Chat GPT, the robot, this morning for a comprehensive list of financial products available to medium and small businesses, and I thought it did a pretty good job. And as I said, in my 30 plus year career and 25 billion of capital transactions of various types, I've done a lot of these. And so what we're going to do today is we're going to review that list sort of top down and just give you an idea of how complicated this can be if you're not involved in the finance industry, and to tell you that what you really ought to be doing, here's the conclusion, is if you're out trying to raise capital, you need an advisor. You need an advisor. You need an accountant or a lawyer or both. You need an intermediary, someone who's involved in this business like myself. By the way, if you just go to a business development officer from XYZ private funding company in the US, what is that business development officer telling you? Are they telling you that here's your business and here's what the financial markets in total have to offer you? Is that what they're telling you? Or are they telling you here's the products that we offer and you meet that criteria or you don't meet that criteria? That's what they're telling you. No business development officer or BDO wants to say no, right? They always want to, we can't help you, but talk to this guy. So they all do that for sure. If they're any good, if they have any integrity whatsoever, they're going to reference you off to the next person. But remember, what they're really trying to do, what they're paid for, is to sell you the product that they've created. When you're raising money for a business, it sort of breaks down into equity capital and debt capital. And remember, this is from the Chat GPT, just a listing of things. And so when you think of equity capital, for example, or any category, think of, I think we need to segment this in two different ways. One is the product itself. So for example, common shares or preferred shares would be an example of what you are selling, the literal security to raise capital for a small business, a new startup, a medium-sized business, whatever, right? So that would be an example of equity. And then you need to also segment it by type of investor, right? Venture capital, angel investment, crowdfunding, private equity, that strategic, that sort of thing. Okay, so just keep in mind as we go through these categories that there will be sort of two different ways to segment this. And I need to think for my content here how to put this into a chart for you. That would be super helpful. I'm not sure with all of the possibilities how I might go about that, but I'm gonna turn my mind to it. If anybody has any suggestions, please feel free to let me know in the comments. So equity capital. So what are you doing when you're raising equity? Well, you're selling common shares mostly. Okay, shares issued to the public or private investors. Public meaning you're doing an IPO or distributing to, in some jurisdictions, over say 50 people. Shareholders, so who you're selling the stock to become shareholders. They gain ownership and they have voting rights in the company if you're issuing them common shares, or you could be issuing them preferred shares, which is just, it's another share, but it's a different class of share. It usually has a fixed return instead of a participating return. It has some priority over the common shares. Remember, when you're pitching to investors, you want to tell them how they get into the deal. So in this case, they're buying preferred shares, let's say. How they get out of the deal, in other words, what is their exit? And with a preferred share, there'd be a redemption retraction time frame, like I'm selling you these shares for 5 years and then you can get out. What are their returns, right? And with preferred shares, it would be, say, a dividend of a fixed amount or some sort of synthetic participation, right, that goes along with it. And then what are your protections? And the point of a preferred share is that it ranks ahead of a common share. So if you're liquidating, you know, the preferred people get their money out first. That's why it's called preferred shares. So those are sort of the products that would fall under that equity category, and the types of lenders would be, say, venture capital, and this is equity investments provided to really early stage, high potential startups. These are high risk, high reward type investments. The typical venture capital model, if they make 10 investments, 2 of them pay off, 2 of them go bankrupt, and the other 6 just kind of bump along and never create a return. And so venture capital is a portfolio game, and you angel investors out there that want to just pretend you're a venture capitalist, you're only doing one deal. You're doing 1 or 2 deals. So you've ignored the portfolio part of spreading that risk out and getting your home runs. And that results in disaster for you. So venture capital, angel investment. Angel investment is individuals. I just talked about that, provided by wealthy individuals who invest in startups and early stage company in exchange for ownership or convertible debt or whatever. Remember, if you're going to the angel community, every community that your business is in, even if you're in the middle of nowhere, United States, in the Midwest somewhere or the South, there will be guaranteed a small group of high net worth individuals that work together to provide angel investments so they can get high returns to startups and small businesses with high growth potential. All right. Remember, if you're selling an equity product, you're selling growth. At the end of the day, that's what you're selling. And so everybody has an angel community. It may be well defined, it may be more secretive, but you can always find it. I can find it in any community I've ever been to because I just start calling the top lawyers in town and asking them, and they have to close the deals. They know who's doing the funding, and usually you can get an introduction. Crowdfunding is another example of people that provide equity financing, raising capital from a large number of investors, usually through an online platform in exchange for equity in business. I've never done this. I've never done crowdfunding. I did look into it once, and I thought it was extraordinarily expensive. The platform itself takes a big chunk of money. You can let me know in the comments if I'm wrong about that perception, but I've never done it. That's what the robot gave us, ChatGPT. I think it missed private equity. Now, that's not really a financing; it's more of a sale of your business, but you usually get to keep some stock, so it's a legitimate transaction. For larger mid-market businesses, say if you're generating EBITDA of 5 million plus, earnings before interest, taxes, depreciation, amortization, but even 3 million, there's some smaller private equities that can get into that. And one thing that you can do is, if you're in a fragmented industry and your business is saying doing $1 million in net profit, well, you can start merging with 3 or 4 other, and all of a sudden you're 1 + 1 + 1, you get up to $3, $4, $5 million of profit. And now you can flip that to a private equity or get financing from a private equity player. Strategic equity, everybody misses strategic because the universe of capital really divides into financial and strategic. And financial investors are those that are looking for a return from your business and just your business. Strategic investors are looking for a return from your business, but also from a synergy that's created from the relationship with your business, because they're probably another business, let's say someone in a similar industry in a different market, someone that is somewhere else on the value distribution chain, like a chain, like a customer or a supplier or somebody like that. You always need to look at strategic as an often overlooked but really productive source of financing. Debt capital. So that was equity capital. So debt capital, of course, is a loan. That's a loan, and it could get more complicated. There could be hybrids. That's sort of a little bit of equity, a little bit of debt, whatever. But your loans break down into term loans provided by financial institutions or private lenders. It's typically tied to a specific asset, piece of machinery. A mortgage would be an example of that. I mean, that's a different type of loan, but not really. So you're buying hard assets, things that don't move, that you buy this asset and you use it and it has a 20-year life. That's something that's appropriate for a term loan. Lines of credit. Lines of credit are also provided by financial institutions, private lenders, and unlike term loans, these are things that are on revolving assets. So things that change every day or frequently. A term loan is on an asset that you buy it and it has a useful life, right? And a line of credit is on things that change. Let's think about things that change: cash, receivables, inventory. These are all things that change. Why? You take some of your cash, you buy some raw materials, which is an inventory, you create a product, so you add value to those raw materials. Now you have a finished good inventory, you sell that finished good inventory, it becomes a receivable because you didn't collect it, and then the receivable, when you collect it, becomes cash. So you've gone full circle, and wherever you are in that process, it just changes every day, as long as you're producing and selling every day. So a line of credit is intended to finance that cycle, and it's very very difficult in most businesses to operate without access to a line of credit. Corporate bonds, it tells us. Don't even worry about corporate bonds. If we're geared here towards medium and small businesses, and corporate bonds are not particularly relevant for that. Convertible debt. This is interesting. So I talked in the equity side about angel investors. Often a way to fund a startup, if you're an angel investor, is like, yeah, I want to give you $100,000 to help you start your business. But remember what I'm looking for. How do I get into the deal? How do I get out of the deal? What's my return? And what's my security in between? Right? While you have my money, how do I know I'm secured and that you're taking me seriously? And if I'm just an equity holder, I'm just equal to you. Maybe we have a shareholders agreement, which gives me a bunch of rights that sort of help me trump you. But better than that, what if I invested my $100,000 as secured debt? So I'm first secured over all the assets, and at my choosing, I can flip that debt into equity and participate in the growth that already happened. So I'm not really taking a risk on that growth. And so convertible debt is a way to do that. It's a lot more complicated than what I just described, but to give you an example of what convertible debt is, SBA loans in the US, and there's similar programs in Canada through Export Development Corporation, maybe the BDC, Business Development Bank of Canada, I'm not sure. But basically, this is the government providing a guarantee on a loan. So you go to a bank, and the bank says, hey, we're hooked up on this SBA program, and we'll lend you a couple $100,000 or $500,000, and the government's going to guarantee, say, 75% of that, which means we're only at risk for 25% of it, and it changes our risk threshold, and so we're willing to extend a bit more to provide you with capital. Right, so those are some examples of debt, but the ChatGPT missed the ABLs, asset-based lending. This is a lot of my 25 billion. Asset-based lending is a type of, we talked already about lines of credit on revolving assets, and term loans. Well, asset-based lending really micro focuses on today's value of those assets, receivables, cash, receivables, inventory, and also incorporates a term loan into there often. So the term piece of that, and then they appraise these assets and they monitor these assets. And because the reporting is so intensive, you get a lot more access to capital. And I will tell you, if you want to affect change in your business, if you want to make more money and change, that requires capital. Access to capital during a period of transition is primary, and ABL's a little bit more expensive, not much, a couple points, a little bit more expensive, but a lot more intensive on reporting, but worth it if you need the access to capital to create change. So that was debt and equity. There's this thing in between called mezzanine capital. which would be subordinated debt, often. So think of it. So subordinated debt is something that's not secured. It's unsecured or junior secured. And so it's ahead of the equity in the ranking, but below the bank in the ranking. So that's why they call it mezzanine. It's somewhere in between. It may have equity kickers. Um, we don't need to spend a bunch of time on that. If you're a medium small business, there's not often a bunch of mezz debt that goes into there the way that this is intended to be. Trade credit. So supplier credit. It changes. Remember we talked about the cash flow cycle. So you buy some raw materials, you add value through whatever, you create a finished good, you sell it, get a receivable, you collect that receivable, you get your cash. Well, what do you do with your cash? Well, hopefully what you're doing is paying your suppliers, because when you bought the raw material, you did it on credit. You didn't have to pay up front. And if you are paying up front, that hugely, now you need the cash before you even start. That hugely changes your cash flow cycle, right? And so the more you can extend out supplier credit, the better off. Just think about it. If your receivable terms are 30 days, so you collect your cash in 30 days and you have to pay your suppliers in 60 days, that's a great working capital cycle, because you have basically free money for 30 days before you have to pay out. But if it's the other way around, if you have to pay your supplier in 30 days and you're collecting in 60 days, you have a shortfall. And the only way to cover that shortfall is with equity. Okay. Or a good ABL will cover that. So always think about your supplier credit. What else do we have here? Grants and subsidies. Government grants, subsidies, often overlooked for small and medium-sized businesses, including startups. Revenue-based financing, royalty. So that would include royalty finance. I think the whole royalty finance industry is dead. So I wouldn't focus on that. Correct me if I'm wrong, those finance people listening to this live stream. Does anybody do royalty financing anymore? This used to be like a Shark Tank thing. I'll invest $1 million in your business and take 10% of your revenue forever. That was kind of a royalty thing. And you still owe me the $1 million, by the way. Merchant cash advances. These are these are products where they just scoop out of your bank account every day their return. So they look at 6 months of bank statements historically, right? And they say, oh, well, every day there's whatever, $100,000. No, that's too much. $1,000 being deposited to the bank. And so we can count on that going in there. So they'd go through a formula and they say, well, we will lend you X amount of money right now, unsecured. Don't even worry about it. Just give us direct access to your bank account and we'll take out the money every day or every week that we need to pay ourselves back, plus a huge return. And they don't tell you what the return is, but it's massive. It reminds me of the 90s with car leasing, when car leasing became a big thing rather than buying. And you would walk into the dealership and you'd say, what's the interest rate on that lease? Like what's the terminal value? What's the AM period? What's the interest rate? And they say it's $360 a month. No, that's not what I'm asking you. I'm asking you what the rate. It's 360. That's all I know. It's $360 a month. Well, that's what merchant cash advances are like. Lease financing. Obviously, this is on capital assets, just like term loans. You can buy your asset with a term loan, finance with a term loan, or you can lease it. And the leases can break down into operating leases and capital leases. There's internal capital, retained earnings. Stop paying yourself so much. Reinvest in your business through less of a salary. And you know what? I want to amend that advice. I know I'm getting over time. Take the money out of the business, but reinvest it in the business. 2 transactions instead of 0 transactions, and secure yourself as a shareholder loan. Okay. Remember, when you have a small business, you have different hats on. You can be a director, you can be an employee, you can be a shareholder, you can be a lender, you can be all these things, and they all have different rights and obligations and rewards. And so formally invest in your business. Let's pick this up here. Specialized financing. factoring, purchase order, inventory, franchise financing, personal capital, friends and family, personal savings, peer-to-peer lending. Actually, I don't even know what that is, crypto. So I'm going to skip that stuff just because we are running out of time. So that's the universe. And my whole point, as I said from the beginning, is there's a lot of products available to help you finance your business, whether it be a startup, a small business, a medium, family-owned business, whatever. There's a lot of products. And before you go out pitching, you should have a general idea of what type of product is going to help you so that you're not getting frustrated and spending all of your resources and time pitching to the wrong people. Okay. So for that, you should get an advisor. And I was going to give an example from my coaching session. Maybe I'll pick that up tomorrow if you don't mind, because I am running out of time. The Dr. Draper, hey, congrats on your new course. Thanks, Dr. Draper. Let's get you on the show here sometime. I'd like to hear from you. It's been a long time. What else do we have here? Anything else I need to address? Because this is all the time that I have. Nope, I think we are good. Thanks, everybody. Hey, hit like, subscribe, whatever platform you're on. If you're on LinkedIn, give me that thumbs up. Maybe give a comment on YouTube, subscribe, hit like, all of that stuff, okay? That's it. Monday to Friday, 8:30 Mountains, live stream. We'll see you tomorrow.